I have a diverse set of interests that include risk management and auditing, and that's what I do professionally. And these perspectives of the business world has really helped my clients solve for problems, reduce risks, and increase their overall profits. I'm Justin Hitt with Inside Strategic Relations. In today's podcast, I'm going to share with you some key concepts to understand when working with auditing agencies and outside firms, such as like KPMG, PricewaterhouseCoopers, PwC, a lot of these big five accounting firms. Now, this is probably not going to be relevant for everybody, but the application applies if you're getting an IRS audit, if you're getting investigated for some reason, and this happens in business situations. You have a contract, the contract has a defect in it, you correct for the defect, somebody's going to quality assure it. Somebody's going to look at it. You have a new business arrangement. You're doing your due diligence for a joint venture activity, and you want to be on the part of the auditor. You want to take the audit position and approach the situation so that you can make the best decision. So one thing to understand is when an outside firm like KPMG or there's a bunch of Deloitte, there's a bunch of firms, they come in, first thing they're going to do is they're going to hoover up as much information as possible. And we're going to get into the strategic relationship part. They're hoovering up as much information as possible so that they can find defects to which extends their engagement. Now, as a consultant, I have done this in the past. I've seen many other consultants do it. They come in and do what's called an initial assessment. The initial assessment will look at something specific in the organization or business. If you're going to do a new joint venture, or you're going to buy a piece of property, you're going to do what's called due diligence. It's an assessment of the characteristics and conditions, the current state conditions of a piece of property, of a opportunity or situation. It might be looking at a process in a business. It might be looking at that process in the lens of a regulatory requirement. So there's a set of characteristics that identify compliant. And when they look at the environment, they gather up as much information as possible. And then they want to play bingo and check every box where there could be a gap in compliance. Now, again, this is part of how the business works. They do this because the more problems they can identify, the more likely they are to reach their objectives. Now, you didn't hire the auditing firm to meet their objectives. You hired the auditing firm to meet your objectives. So what you really must do is three very important things. Number one is you must clearly define the scope of remediation. Okay, because they're going to find a lot of problems. Which of these problems can you solve? Which of these problems matter? Which of these problems are more important to solve over others? Next, you're going to inventory of all your findings, because what they're going to do is give you a very vague list of problems. And they're going to say, here's the problems we found. Tell me more about your approach. Give me the end-to-end diagrams that show me at an element level these details. They're going to, again, do what's called discovery. And they're going to gather more information, narrowing their focus to figure out which of these problems is the big pressing problem so that they are not fired for finding so many problems. See, if an employee found that many problems, they'd be fired. But this is an outside consulting firm. And like gods coming off the mountain, they send a bunch of MBA college students over to find problems, which then they send their findings to someone to make slide decks, and then they do these presentations, and the CEOs are wetting their pants. Oh, I've noticed this thing here. The FTC fined so-and-so $3 billion for doing that, and you doing it 3 times. Oh, you could get fined. They're really digging up as much dirt as possible so that they can hold the assignment or the engagement as long as possible. It's the way it works. That's the way the industry works. However, again, if you can scope the work, clearly scope the work, you can at least address the problem at hand. Number two is within that scope of work, all of these discovery items, you only provide back the items that in the discovery that are relevant to the scope of work. Don't worry their pretty little heads in KPMG, and I know I'm picking on KPMG, but don't worry their little heads in the big five auditing firm about all of the details when they asked for these specific details. because it is their nature to find more problems. And really, they found enough problems. Let's solve those problems in order of priority first. Third thing you're going to do is you're going to maintain an inventory, because you will find useful things to solve for in your organization. Except, here's another problem. All your employees, all the staff people on these teams, as you find these problems, they see it as an opportunity to grow their teams, as an opportunity to retain their employment, as an opportunity to demonstrate how successful and beneficial they are to the organization. And ultimately, your project goes from a few findings to thousands of findings. It grows exponentially. Have you ever been in that situation? You know, your tax return gets audited by the IRS. IRS finds 50 things wrong with it. Now, some of those things they find are minor, and some of those things are major, but they assign a fine to every bit. And the IRS wants every little element taken care of. And you thought the tax return was good when you sent it in. You just want them to go away. It almost becomes a blackmail extortion type of thing. But it's the nature of the audit or the consulting engagement. It's not bad, actually. And in fact, it could be the cheapest possible way to find defects in your organization. Because if the auditing firm comes in and finds a list of 30 problems, and as you're investigating it, you find out that there are not just 30 problems, there's 300 problems. You know the 30 problems that they saw are likely the most pressing. But of those 30 problems, what are the 2 that we can solve right now? So from your perspective, you're going to package this up, and you're going to start having success after success after success by narrowing the scope to the critical path. Again, you're going to have an inventory of the processes and the different groups that are involved and the different risks that are in the environment, and then any of the controls that you have for those risks. These inventories are universal, and they start helping you map out the interconnections between this complex activity. So you're going to buy a piece of property. The property has a title on it. If you don't do a title search, somebody could claim that property after your purchase. And in fact, there's a scam that they do in commercial property sometimes where they'll sell you a piece of property and then they'll come back on a title claim and take the property away from you. And then basically they have lawyers that they recommend. It's just a pain. With a property, if you're going to build a house on it, there's perk tests. So you need to have the perk test done, because if you buy a piece of property that you can't build a house on, then you're going to have problems, right? There's also zoning. There's like 50 things you got to do to buy a piece of property and have fewer problems. And it's better to find out those things up front than to get in the situation and the problems arise. That's why you hired the auditor. You want that third party perspective, this lens of anal retentiveness that's going to pick and dig and look for problems. Now, they know in order to find the maximum number of problems and to guarantee the maximum billable hours, they got to suck up as much information as possible. And if you understand how the system works, you do want to know the problems exist. Don't get me wrong. You're not going to feed them information that gives a certain narrative. You're not going to hide anything. But internally, you're going to prioritize and evaluate with internal people the prioritization. Now, when I worked in government contracting environments, we would have the federal government come in and do their assessment of labor hours, for example. And they'd look at our timesheets that were itemized, and they'd look at the work that we're doing. And so the government accounting office would come through and kind of audit a contract. Now, a lot of times the managers would prep us for this, and they'd say, oh, here are the things you can say, here are the things you can't say. You can be honest, but don't be too honest. That's bad. That's really sets you up for failure, because you do want to know if there are any gaps. If somebody's falsifying their timesheets, or if the program is using one kind of money for the wrong type of activity, you want to know this stuff. Ideally, though, you want to know it internally first before the auditor comes out. So we go back to the IRS tax return. You're being audited by the IRS. Wouldn't it have been nice to have a really good tax return up front? Now, audits can be random, so you can get audited even though you have the perfect tax return. But wouldn't it be nice that if you got audited, You had a nice tax return. You had good evidence about why you put things on the tax return. You had a narrative put together that referenced the applicable law that had the rationale about why you put things on your tax return. And then you had a qualified CPA or tax attorney involved rather than yourself. Wouldn't all that be great? Now, I hear what you're saying. You're saying, well, Justin, if I did that every time and I might never get audited, it seems like I've wasted a lot of time. And I've put a lot of effort up front creating artifacts and evidence and indexes and cross-reference information. And I wrote down the name of I collected all these receipts and put them in boxes. And I wrote down the name of the person that was a client when I drove my vehicle out there. And it was only, worth a 10-cent deduction, but it took me $2 to write down the name. Listen very carefully. When your eyes are open to strategic relationships, you start to realize that doing things the right way, there's a level of accuracy that is appropriate for the tax return. So if you've got a $40,000 a year tax return that's 2.5 pages, yeah, you can go down to H&R Block and just have them do it for you. But when you're a high-income professional, an entrepreneur, or somebody running a business, and you've got a 48-page tax return that has rental properties, business income, dividends from stocks and investments, multiple types of retirement accounts, employee stock option plans, maybe even a little W-2 income thrown in there, multiple incomes in the one family, depreciation for different types of asset categories, it is just so much easier to every day take down the right notes and the right paper, fill out the right forms and paperwork, maintain a ledger, maintain some kind of binder that every house that you own has a binder and it keeps track of when things were installed and such, and just do it as you go rather than having that one time in your life that someone comes along and sees what a mess you've got and wrecks it all up. So record keeping is more valuable than legal discovery. Because if you ever had somebody come across and do legal discovery, you just collect the information up and give it to them. Again, you scope it, like we talked about. You get agreement about what deliverables should look like. If you find other stuff and they mention it, or you mention it, or you find it, or they find it, you keep track of those things. So, the IRS comes along and asks you about this and you discover that. You write down that as well, address this that they identified. Same thing with a property purchase. A joint venture, mergers and acquisitions, that due diligence up front is difficult. Don't get me wrong, it is difficult. But if you get the right professionals in place and you document and have good record keeping, it will not be any more difficult in the future. Now, it definitely is easy if you don't do any of this stuff, and maybe you like to fly by the seat of your pants because you're a brave and daring, a trailblazer. But the fact of the matter is that if you do enough deals, there's something's going to go wrong. It just always goes wrong. Something happens. I did a deal where I hired in subcontractors, and my contract said they don't get paid until I get paid. They don't get their money until my money clears the bank. Even with a bulletproof contract, one of the contractors, I had 27 subcontractors. They could have 10 to 100 people on their team. Okay. One of the subcontractors decides to corner me in the parking lot, and they kept shuffling around the lot so that their back was to the sun. And there are 3 of them, and they were bigger than me, and they were all surrounding me. They're saying, well, I'd like to get my money. I'd like to get my money now. What are you going to do to get my money now? I said, well, the contract says this. I don't care about a damn contract. I need my money. And they were shaking me down for, I don't know, maybe a little bit under $100,000. And I understand the concern because I had not gotten paid by my client. And all I could really tell them is, look, we're going to abide by the contract. If you need a loan or you need an advance or something like that, we can talk, we can work that out. But here's what I'm going to do. I'm going to go talk to the client. I'm going to go and find out what's going on. But I have no guarantee that I'm going to be able to do anything except what's in that contract. And these types of things happen. But again, I had a contract in place. I had clear terms. I had a lawyer who could then answer specific questions they had because they had clearly misunderstood my contract. I had also been able to arrange through having good, clean cash flow and having a good contract with my client. I was able to arrange an advance by getting paid by the client. And then as soon as the money cleared, I was able to pay the sub. Now, I gave preference to that sub that was the squeaky wheel because I didn't like getting taken out in the parking lot by former military who were insisting heavily that they were going to pay, that I was going to pay them right then and there. Just get my point here. You can go the easy route and not do very many deals and do them sloppy and then have a lot of problems show up in the future. It is possible you'll have no problems show up in the future and you'll think I'm silly for taking notes. Or you can find the happy medium between the notes required for you to understand and manage effectively the work at hand, to anticipate future problems and possible scenarios where you might be on the short end of the stick, and to ultimately protect your interests versus the level of detail that maybe an auditor is looking for. The auditor really does want to suck up as much information as possible. They say, well, I want to see every transaction you've made on this bank account. Give me 7 years of statements. They don't need 7 years of statements. They need 7 end of year profit and loss statements. They don't need every transaction, but they want every transaction because they feed it into a computer system that finds stuff. They're looking for money laundering and they're looking for obscure laws that you've broken. They're looking for a lot. Again, identify the scope, prioritize. But I want you to be with an attitude to understand that anything an auditor finds, whether you hired the auditor or the auditor magically showed up or you got randomly selected for something, you want to be thankful for them finding things, but you want to manage the relationship. Hey, regulator, I am so thankful you discovered these things and you had pointed them out because here's our audit findings that didn't identify this problem. And, we went through quarterly audits and we still didn't find this problem. So I'd actually like to ask the question, show me your paperwork. How did you find this issue? Now, I was in a situation, I'm going to wrap up shortly after this, but I was in a situation where some pretty big end auditors found, regulatory auditor type folks, found some things and presented this giant laundry list of problems. Now, for the majority of the problems on the list, we were able to demonstrate quarterly audits, not finding these things. So we checked the audit because, our auditors internal folks could have been doing something wrong. And then we presented our evidence and the auditor said, oh, well, you know what? We'll take those off the table. Because somebody on their side took a shortcut. And somebody on their side basically said, well, if they have concerns with these laws, they probably got concerns with these other laws, so I'm just going to throw them on there. Turns out, with the proper evidence, with the proper documentation, change management's important. How you delegate work, the high-level processes you have, how you handle risks and controls, this all matters. And the larger your organization, the more it matters. But in this situation, they were able to, at the part of scoping, take things off the table that they could prove were not relevant to the outcome the auditor was going towards. It saved millions of dollars. Millions of dollars. Now, some poor sucker like me had to go out and do the research, and we had to work with the business units, and some of the business units had gaps. And there were gaps as wide enough to drive a tractor trailer through, but they weren't relevant to the scope of the audit. So we noted those gaps and we fixed them. Because see, that's what you're supposed to be doing. Constant improvement. You're going to fix the stuff in your organization as you find it. But if all that got hoovered up, the auditor would have gone from an invalid concern to a valid concern not related to the original inquiry. And that guarantees they can come back for more money. If you're paying the auditor, it guarantees they can come back. If you hire an accountant to find out what's wrong in your business, they're always going to find something wrong. It's just the way it works. But again, you've got to scope it. You've got to define deliverables. You've got to use internal inventories to get an understanding of the real state of your organization. You've got to address their concern or their defect separate of the larger addressing of the general problems that every business has. And when you do this, it puts you in a position to not only control the narrative, not only to solve the problems that were found, but to eliminate the problems that are unseen at the point of the original investigation. This is powerful stuff. Now, I've had the good fortune of having relatives. They were IRS auditors and having people work for Department of Justice and some real anal retentive people in my social circles. When the stakes are high, you hire somebody like myself to come in and help you with strategy, to help you with the approach, understanding the relationships. Because when you find a problem, the group that found the problem isn't necessarily the group that fixed the problem. You might need to find out who in the organization can solve the problem and turn that work over to the other group. But this can be a very complex discussion and very sensitive for organizations. So it's not something I'm expecting you to ask about on a paid consultation. And usually we keep things very high level at that point. But you've got to understand that the more problems they can find, the KPMG, the big five auditors, the more problems they can find, the longer they can stay engaged with your organization. That's number one. Number two, regulatory folks, the more problems they can find, the more they can fine you. And I have a special report about this, how the government uses regulations and laws as fundraising. Now, I'm not going to go into that now, but understand the more they can find, the more they will find. And number three is it's not in your best interest to hide this stuff. It's in your best interest to scope it, prioritize it, to address it, and to make sure you're proactive in your organization with your risk management, with your compliance, with your overall, processes. Make sure they actually do what you expect them to do. The benefit of all this is you can find ways to save money in the organization, the ways to better serve your customer, ways to stay out of legal trouble. And this is not by hiding the bad things you're doing, by eliminating the bad things you're doing, really driving that value in the marketplace and making your organization bulletproof. It's really an important thing, and it's worth billions of dollars to Fortune 100 organizations. It's worth hundreds of millions of dollars to any size organizations, and is one of those factors that guarantees you can scale. I'm Justin Hitt with Inside Strategic Relations. I hope to have given you a view into some applied strategic relationships, understanding the perspectives and desires and narratives of individual groups who you may interact with on higher ticket transactions or higher risk activities, but ultimately how you can transform business relationships into profits. Profits by saving time, profits by solving problems, and profits by better serving your customers. Thanks for listening. If you have questions, visit www.insidestrategicrelations.com.